Hey CFMA, my name is Mike Stevens and I'm a principal in our construction group at CLA. I'm also a member of the Chicago chapter for CFMA. So today I'm going to talk to you about lost contracts. Okay, so hopefully these don't come up often, but they do come up in the industry. And we're going to talk about three main areas. The first is what is a lost contract? The second is how do I account for the lost contract? And the third is how does this get presented within the financial statements? So a lost contract is really when the contract costs exceed our contract value. Okay, so within our contract costs, we should also make sure we're including both our direct and indirect costs in that estimate. There are times where contractors only include their direct costs, but they should also be including indirect as well. Okay, so let's walk through an example for how this gets recorded and really what the kind of the debits and credits are for these types of contracts. So if you see here, we have our WIP schedule. So in year one, we have a contract of $100,000 with total estimated cost of $110,000. So if we're using our percentage of completion method and cost to cost, if we have $55,000 of direct and indirect costs in year one, we'll have revenues of $50,000. Okay, but with a lost contract, the thing that's different about these is that we have to record the full loss in the year that it's known. So right now, we would only have a loss of $5,000. So what we need to do is record an additional accrual of $5,000. So that's what that $5,000 in the orange column is. So if we go all the way to the right, then for year one, we have revenues of $50,000, costs of $60,000, and we have our loss of $10,000. So the cost of $60,000 is made up of our direct and indirect costs of $55,000 and our additional loss accrual of $5,000. Now let's look at year two. So year two, we complete the project. We have cost to date of $110,000. So for the current year, we would again have $50,000 of revenue, and our total costs would be $50,000. So for a break even for this year. And now this $50,000 of costs is made up of our direct and indirect costs of $55,000 minus this loss accrual from the prior year of $5,000. Now let's walk through some examples, and I think it'll make a little more sense to see how the debits and credits flow. So here we see year one, we have our contract costs of $55,000, accounts payable of $55,000, and then we have our revenue and receivables of $50,000. So what's unique is this provision for contract loss expense account. So we are going to debit that for $5,000, and then we're going to credit a liability account for $5,000. So that's the unique part. That's that additional accrual to bring us to a loss of $10,000. Now let's get year two. Year two, we have the same activity for revenues and costs, but now we get to take credit for the loss we recorded in the prior year. So what we'll do is we'll credit our provision for contract loss expense account, and we'll debit the accrual on the balance sheet to remove it. So what that does is now in year two, we have a break even. And over the life of the contract, we've recorded a loss of $10,000. Now, how this gets presented on the financial statements, so sometimes contractors will roll this into their contract asset or contract liability numbers via the under and over billings, but this should really be presented separately from contract liabilities and contract assets. So if it's material, we could record it as its own line item on our balance sheet, or if it's not material, it could be recorded within our accrued expense line item. On the income statement, again, if it's not material, it will still be included in contract costs to get to our gross profit. And if it is material, we could break it out separately. But really, we should make sure that it's still in contract costs and still being used to compute our gross profit, right? It should not be included as a reduction of revenues. So with that, I hope you are able to account for lost contracts, and I hope you don't have to use it that much. Have a great day.